Hello students, welcome back. So today we are going to start with the revision of our second part of portfolio management. So we have already revised in the first part of portfolio management about what is your modern portfolio theory, in which we learned right from the basics how do we calculate the return of a security, risk of a security, return of a portfolio, risk of a portfolio, for a two security portfolio, for a three security portfolio, what should be the interactive risk using covariance, then correlation coefficient, then dilution of the risk in a portfolio when R is -1, +1, R is 0. We all covered that in your modern portfolio theory in the first part. And then we also continued that with capital asset pricing model. We learned how to calculate your beta. We revised what is your KE formula, how do we calculate portfolio beta, then what is the formula for your expected return using CAPM, then regression equation. All these things we had covered up there. Without wasting any further time now, we are going to start with our second part where we'll be continuing from that proportion, from that particular part. We have covered your CAPM part, and now we are going to start with the next section, which deals with your relationship between covariance and the beta of the securities and all. So if you are seeing this video for the first time, just make sure that you all see the first part revision as well, because that will be really helpful for you if you're revising portfolio management, and then follow this in particular sequence, because entire chapter I've divided into various subparts, and based on these various subparts we are doing these questions. Okay, so uh, coming to the point, one standard instruction which I always give at the start of my revision series lectures, and that is, please keep your notebooks handy, keep your calcies handy, and we'll be revising almost majority of the questions, and some of the questions I'll be just showing you the solutions, and we'll be doing it in that way. Where I feel there is a need, we'll be solving those particular questions. Whenever you are revising a particular concept, you are understanding the concept, and then you're seeing the questions, and whenever you feel okay, fine sir, this is done, okay, and you're able to solve it, just pause the video, solve the question on your own, okay, and see whether you're able to get the answer or not. Okay, so just don't revise randomly, revise with a strategy. Okay, solve it in front of me, and I'm very sure that all your concepts will be absolutely clear once we cover all these things. Okay, so coming back now, uh, now in this particular video, I'll be starting with what is the relationship between covariance and beta of the two securities and the market variance. So when am I going to use this particular concept? Okay, so just very quickly, as you all are aware about the fact that uh, whenever you want to calculate the covariance between the two securities, it completely depends upon what type of data is given to you in the question. Whether there is past data which is given to you, or my dear students, whether there is any future estimates which is available. Now, my dear students, whenever I talk about past data which is given to you, so in case of past data, how do we calculate the covariance? We calculate the covariance by taking summation of RA minus RA bar and RB minus RB bar. This was the formula for joint deviation, right? Which we used to divide by N. And whenever there was future estimates, we took summation of probability into RA minus RA bar and RB minus RB bar, right? So this is how we used to actually calculate your covariance AB. Now, my dear students, I am teaching you something very interesting, that when neither do we have past data or neither do we have future estimates, but now still we are required to calculate what is the interactive risk between the two securities covariance AB. Then we can do this with the help of beta A into beta B, which we need to multiply that by the market variance. So this is the formula to calculate your covariance AB when neither of the past data or the future estimates are available. Now you must be wondering, sir, in this particular case, how do we get your covariance AB? Because beta A is the sensitivity of the stock with the market. Beta B is also the sensitivity of the stock with the market. And this is nothing but your market variance. Okay. So how are we going to take this into consideration? Now see, my dear students, if suppose Reliance is lifted with Nifty, so we know the sensitivity of the Reliance with Nifty. Tata Motors, that is also listed with Nifty. So we know the relationship with Tata Motors and the sensitivity of Tata Motors with Nifty. So now in this particular case, using this data, we are going to find out what should be the relationship between Reliance and, okay, and for that we take beta into beta B and we multiply that by the market variance. Okay, so this is how we calculate your covariance AB. So always remember that whenever they ask you to calculate the interactive risk, but you neither see past data or the future estimates, then can I say your covariance between the two securities can be calculated using this particular formula? Come on, yes or no? Yes, sir. Okay. Now, my dear students, let's do one question regarding the same. So I want you to come to question number 35. The following details are given for X and Y company stock and the Bombay Sensex for the period of 1 year. We are required to calculate what should be the systematic and unsystematic risk for the company stock. Okay. By the way, you all know what is systematic risk. I've done this in part 1, but still I'm revising it now. Can I say systematic risk is nothing but the risk of the security, okay, when it comes to your market risk? So basically, what do we take into consideration for your systematic risk? We take your market risk and multiply that by the beta. Will that give you the systematic risk? Yes or no? Yes, sir. Now see, there are two types of risk. The first type of risk is your systematic risk, which deals with your political risk, market risk, interest rate risk, etc., which can be diversified, which can be eliminated or reduced through the process of diversification. Then the answer is no. Okay, systematic risk cannot be reduced or eliminated through the process of diversification, but unsystematic risk, can I say that we can reduce it through the process of diversification? Yes or no? Yes, sir. Why? Because systematic risk, my dear students, that is going to affect all the securities in the portfolio. But unsystematic risk, that is something which is regarding the company's risk. So it is regarding your labor problems, strikes, etc. So because of that, only management problems. So because of that, only company is going to be affected. So those are called as your unsystematic risk, right? So systematic risk is going to impact everything and everyone, okay, which is there in the portfolio. Now, in this particular case, if you want to calculate the systematic risk, what do we take into consideration? We consider your market risk. Suppose your Nifty risk is 10% and the beta of the stock is 1.5. Then can I say 15% will be treated as your systematic risk? Come on, yes or no? Yes, sir. Also, now, my dear students, higher the beta, higher is going to be your higher is going to be your systematic risk. Always remember like this for a particular security. And my dear students, whenever we talk about your unsystematic risk per se, we don't have any formula. We take total risk and from that we subtract systematic risk. What do we get is unsystematic risk. So for example, your total risk, which is nothing but the standard deviation of the security. Suppose the standard deviation is 20% and the systematic risk is 15%. Then your unsystematic risk or your residual risk will be nothing but 5%. Okay. So always remember like this, my dear students, that whenever we are talking about your unsystematic risk, we don't have any particular formula for the purpose of calculation. So we always consider that as residual risk. So from the total risk, we subtract your systematic risk to eventually get your unsystematic risk. Now, my dear students, systematic risk can also be calculated based on variance. So this was systematic risk based on standard deviation. If you want to calculate systematic risk based on variance, then what we need to do, we have to take whatever is the market variance and multiply that by the beta square. So that's how we can calculate the systematic risk based on your variance. And what about your unsystematic risk? That is nothing but total risk minus your systematic risk. That will give you your unsystematic risk. Okay. So whenever they ask you or give you information regarding variance of a security, so here what is variance? Variance is nothing but standard deviation square, right? So sometimes they will give you, instead of standard deviation of a security, they will give you variance of a security. So once they give you variance of a security, can I say they are expecting you to calculate the systematic risk based on variance? So we will take variance of market and multiply that by the beta square. So that's how we'll be getting systematic risk. And your unsystematic risk is nothing but your total risk. From that we subtract the systematic risk. Now in this particular question, see what they have asked. We are required to calculate your systematic and unsystematic risk. And if equal amount is allocated for the stocks, what would be the portfolio risk? Okay, so we are required to calculate the risk of a portfolio. And we have X, Y, and your Sensex, where we have the average returns available. We have variance of the returns available. So variance of the return, what is it? Can I say that is nothing but standard deviation square, which is given to you. Then we have beta available. We have correlation coefficient, but that is given to you for x. So we have correlation coefficient, which is rho, and this is nothing but rho square, which is also called as coefficient of determination. Okay. So this is the data which is given to you. We are required to calculate what should be your systematic risk and what should be your unsystematic risk. Okay. So this question, we can do this together. Okay. For your question number 35, very quickly we will revise this. Uh, See, because first of all, this is for the first time you are seeing that we are required to calculate your systematic risk. So how do we calculate your systematic risk first of all? So systematic risk can be calculated by taking beta and we can multiply that by the market risk. Okay. But here, as you all can check, we have variance of the returns. So basically we have the data which is given to you on the basis of standard deviation square. So that is why I can calculate the systematic risk based on variance. And what will this be? Can I say beta square into market variance, right? Okay. So what is now for your security X and security Y, what is your beta? So as you guys can just check, your beta is given to you as 0.71. So this is 0.71 square. And what is the market variance? So the market variance, they have told you that is 2.25. Okay, variance of a return. So that is standard deviation square. So this is 2.25. So we have this as 2.25. Similarly for Y, we have the beta square, which is 0.27, and this 0.27 square, I need to multiply it by the variance of the market, and that is nothing but 2.25. So is this data sufficient for you to calculate your systematic risk? Yes, sir. So that will be 0.71 square, which we can multiply by 2.25. So this is 1.13, and 0.27 square, which I need to multiply it by 2.25. So this will be 0.16. Now, my dear students, we have already got what is your systematic risk. So from this, now, if I want to calculate unsystematic risk, how will I do that? So the total risk, now what is the total risk? Total risk is always measured with the help of standard deviation, as you all know, because I've explained this to you in the previous video, that in case of the total risk, we are actually having the standard deviation, okay, entire standard deviation, which is the movement from its average. That is your total risk. So we have the total risk which is available, and that is given to you in the form of the variance. So that is 6.3. And now from this 6.3, what I need to subtract? I need to subtract what is my systematic risk. So that is 1.13. As you all can see, everywhere I've taken variance only. So 6.3 minus 1.13, this will now give you 5.17. And what about your Y? So for Y, what is the variance which they have given you? 5.86. So now from 5.86, if I subtract what is going to be your systematic risk, which I've got it here, that is 0.16. So 5.86 minus 0.16, so that is nothing but 5.7. So is this going to be treated as your unsystematic risk? Come on, yes or no? Yes, sir. Okay. So now, my dear students, we have your systematic risk and we have your unsystematic risk available. Now, what is to be done next? Okay, that's the first part of the question. So we have calculated this based on variance. Again, I'm repeating, whenever the variance is given to you, ICAI prefers that you calculate this on the basis of your variance. Now, in the second part, if equal amount is allocated for the stocks, what would be the portfolio risk? Now we are required to calculate what should be your portfolio risk. So now this risk of a portfolio also, can I calculate based on variance? Come on, yes or no? Yes, sir. So we can calculate this based on your variance. So how do we calculate this risk of a particular portfolio? Now comes your Harry Markowitz modern portfolio theory. So in this particular case, I will be taking weights of A square. Here it is X. So I'll take weights of X square into your variance of X plus weights of Y square. You understand the flow of the question, into variance of Y plus 2 times weights of X into weights of Y into whatever is your covariance XY, right? Is this formula sufficient for you? Now you must be wondering, sir, you have forgotten root, but this is already variance. So that is standard deviation square. Okay, so there is no need for any root for the same. Now, what is your weights of X square? So my dear students, they have told you that if equal amount of the money is to be allocated. So can I say this will be 0.5 square? This will also be 0.5 square. Okay. Now, what is the variance of x? So that is 6.3, no problem regarding this. What is the variance of y? So that is nothing but 5.86, again no problem. Okay, plus 2 times your weights of x, which is 0.5 into 0.5. But now I don't have covariance xy, but there is no need to worry. Covariance xy, my dear students, can I calculate this with the help of past data or future? No, that is not available. So we need to calculate this with the help of beta. So now how will you calculate your covariance xy? So can I say you will take beta of x into beta of y into whatever is the market variance. And you know what? All this data is available. So do we have beta of x? Yes, sir. How much is that? So your beta of x is 0.71 square, 0.71 only, sorry. Your beta of y is nothing but 0.27. And what is your variance of the market? So variance of the market is 2.25. Okay, 2.25. So now with this, I can calculate what is the covariance xy, which is 0.71 into 0.27 into 2.25. So it's coming as 0.43. Now, can I substitute here 0.43? Yes, sir. So on the basis of this, I can calculate what is going to be your variance of the particular portfolio. So 0.5 square multiplied by 6.3, 0.5 square multiply that by 5.86, and then we have 2 into 0.5 into 0.5 into 0.43. So this will be nothing but 3.255. So is this nothing but your risk of a portfolio which is based on the variance? Come on, yes or no? Yes, sir. And how much is that? So it is coming as your 3.255. Okay. So with this, my dear students, at least we know that this is the variance. Now you must be wondering, sir, why we have not used this correlation coefficient, okay, for the purpose of determining interactive risk. Now, who knows this is the correlation coefficient of between the two securities, or is it between securities and market? Because it can be between securities and market as well, right? So correlation coefficient, it can be between the two securities also, and it can also be between the security and the market. So we don't know. So that's why we calculated this covariance, okay? But if you want to check that whether this correlation coefficient is between the two securities or not, then my dear students, I'll take you one step ahead, okay? So now this will be your proof that the correlation coefficient is not between the two securities. It is between the security and the market. How? As you all know, what is systematic risk? Can I say your systematic risk is nothing but whatever is your beta, which I need to multiply it by the market risk, right? This is nothing but your systematic risk. Now, my dear students, if I want to calculate systematic risk based on variance, then what is this going to be? Beta square into market variance. And then if I tell you that, what is your beta square? So what is beta square? Can I say correlation coefficient of the security with the market into whatever is the standard deviation of security upon standard deviation of market. Okay, but this is square. So I need to multiply this by market variance. Now, as you all can see, this gets cancelled. So basically, we are left with what? Correlation coefficient of the security with the market, right? So this is apparently called as coefficient of determination. What is it called as? Coefficient of determination. Now, why do I say coefficient of determination? Because, my dear students, in this particular case, in this coefficient of determination, you know it is r square. So whenever, my dear students, it is r square, you all are aware about the fact that this is nothing but your coefficient of determination. Okay. So we have coefficient of determination, which I can multiply this by, this is risk of a security, right? So this is nothing but variance of security. Now, why do I say variance of security? Because it is standard deviation of security square. So that's why we treat this as your variance of security. Now, what is the coefficient of determination? Just check. We have the coefficient of determination as 0.18, and I need to multiply this by your variance of security, and your variance of security is nothing but 6.3. So if I do this, will I be getting the systematic risk? Yes, 0.18 into 6.3. So this will eventually give you 1.13. So this is the systematic risk. Now just check what was the systematic risk which we got here. This is 1.13. So this is also 1.13. So what did we assume to calculate this 1.13? We assume that to calculate this 1.13, we have to take coefficient of determination into variance of the security. And this coefficient of the determination should be between security and the market. So can I say it gets proved, my dear students, that this coefficient of determination is given to you between X and market. So you can just write down here by the way of a note. And what will be the note? That correlation coefficient is given between security and market. Okay? We need interactive risk. We need interactive risk between two securities. Okay? So that is why, my dear students, we take into consideration whatever is your correlation coefficient of determination, which we need to multiply that by the variance of the security. Fine. So I hope you all have understood this question number 35 very thoroughly about what is your systematic risk and what is your unsystematic risk. Okay. Now, question number 36. Now, this is also based on the similar concept. See, what is given to you that a study of a mutual fund has revealed the following data in respect of the three securities, where we have security A, B, C, then we have the standard deviation, then we have correlation with the index. So that is nothing but correlation coefficient of the security with the market. The standard deviation of the market portfolio is observed to be 15%. So this is risk of the market. We are required to calculate in the first part. What is the sensitivity of the returns of each stock with respect to the market? So we are required to calculate beta in the first part. What is the covariance amongst the stocks? So we are required to calculate covariance AB, BC and AC. That is how we can calculate the covariance interactive risk between two securities. What would be the risk of a portfolio consisting of all the three securities? What is the beta of the portfolio consisting of equal investments in each stock? And what is the total systematic and unsystematic risk of the portfolio in the fourth above? So basically, these all things we are required to calculate. Okay. So do we have the total risk of each and every security? Come on, yes or no? Yes, sir, we do have it. As you all can see, security A is 20%, security B is 18%, security C is 12%. So we definitely have what is the individual risk between these three securities. Now, my dear students, first step is we are required to calculate what is the security beta sensitivity. Okay. So now in this question number 36, how do we calculate the sensitivity? So sensitivity, can it be calculated with the help of the beta? Come on, yes or no? Yes. And what's the formula for beta? The correlation coefficient of the security with the market into standard deviation of security upon standard deviation of the market. Okay. So just now I explained you that the correlation coefficient was given to you of the security with the market. And here also it is given to you that this is nothing but the correlation coefficient of the security with the market. So will this help you to calculate the sensitivity? That is nothing but beta. Come on, yes or no? Yes, sir. Because for beta, we take correlation coefficient of the security with market into your standard deviation of security upon standard deviation of the market. So that's how we calculate the beta. So now, my dear students, we have all this data available. We have correlation coefficient. We have the standard deviation of the security. We have the standard deviation. So do we have all the data on the basis of which we can calculate the beta? Come on, yes or no? Yes, sir. What are the covariances amongst various stocks? So now to calculate your covariances, always remember, to calculate your covariances, search for past data or future estimates. If that is not mentioned, then can I say that here they have told you that we are required to calculate between x, y and z. So let's say, for example, this is x, y. So what will this be? Beta of A into beta of B into standard deviation AB. So this beta of A is nothing but your covariance. This beta of A is nothing but your, in this particular case, your sensitivity, okay, which is given to you. Now, that's it. So on the basis of this, we are required to calculate what is going to be the covariance between AB. Similarly, I'm going to calculate between BC, and similarly, I'm going to calculate between AC. So once we'll be having the covariances, can I use the three security portfolio formula to do the calculations? Yes, sir. So that's what they have all asked you in this particular question. And now, see, one question I had kept it, I revised it when the systematic risk and unsystematic risk were to be calculated based on the variance. Here in this particular question, they have told you that this is required to be calculated in each investment. Okay. And also we are required to calculate this total risk, systematic risk and unsystematic risk. So always remember this, my dear students, that whenever we are calculating this, what is going to be your risk of the portfolio, then what we will do, we will use whatever is the weights of A square into variance of A, plus similarly for the 3 plus 2 times weights of A into weights of B into your covariance AB. So you need to calculate this for covariance AB, BC and AC, right? And then on this basis, the calculation will be done. Okay, so this was regarding your question number 36, extremely easy, but still I'll just present you the solution. Okay, so this is the sensitivity of the stock with the market. Okay, so how do you calculate beta? Covariance of AB on market variance, right? That's how we can calculate the beta. Come on, yes or no? Yes, sir. Okay, and also we can calculate, because here in this question we have correlation coefficient, so we can use this formula. Correlation coefficient of the security with the market into standard deviation security upon standard deviation. Okay, so this is how we are going to do the calculation. So this is how we'll be getting beta. So this is how we calculate the covariance, then calculation of the risk of the portfolio. Okay, and then after that we are going to have beta of the portfolio and systematic and systematic risk. Okay, and then we are having your total risk. So that's it. So with this now, my dear students, your question number 36 also gets completed. Okay. So now, my dear students, continuing further, now we are going to revise what is the concept of your least risk portfolio. Okay. Now see, I want your full attention now on how do we calculate your least risk portfolio. So I think now, I hope you have understood that if suppose we need to calculate the risk of a portfolio, but the interactive risk, that is covariance, is not available to you based on the past data or the future estimates, then we can calculate your covariance between the two securities by taking beta of A into beta of B into market variance. Now, my dear students, we are learning about what is the least risk portfolio. Okay. So, my dear students, what is a least risk portfolio? It is that combination of weights where the risk of the portfolio is the minimum. Okay, and at a particular correlation coefficient, it can also be zero. Okay, so first of all, what is your least risk portfolio? It is that combination of weights. Okay, so least risk portfolio is the combination of weights in which your risk of the portfolio is minimum. So we are not concerned here with the returns. We are just concerned with the risk of a portfolio, and it's that combination of weights in which the risk of the portfolio is minimum. Now, my dear students, as you all are aware about the fact that with two securities in a portfolio, we can have unlimited portfolios. We can have infinite portfolios, right? So if I have two securities in a particular portfolio, I can have a weight of 10%, 90%. I can have a weight of 5% and 95%. I can have a weight of 40%, 60%. I can have a weight of 50%. So we can have infinite number of your possible portfolios which can be done with your two securities in a particular portfolio, right? Now, my dear students, understand like this, that whenever we are required to calculate the risk of a particular portfolio, okay, so basically we take into consideration weights of A into variance of A plus weights of B into variance of B, and so on. You know, we take that particular formula. Now, my dear students, we want to have the risk of the portfolio to be minimum. Okay, so as I told you that with two security in a portfolio, infinite portfolios can be created. Now, if I plot this in a graph, okay, where I take here what should be, let's say for example, your returns and what should be your risk, then if I plot these portfolios in the graph, then you know it can be plotted like this. Okay, because there can be multiple combinations of security A and security B. Okay, so it can be, let's say for example, 5% weights of security A and 95% of security B. Now in this particular combination, it is very much possible that your return of a portfolio can be 15% and your risk of a portfolio can be 10%. Okay, again at a different combination, let's say 10% and 90%. Suppose your return on a portfolio is 13%. Okay, and the risk of a portfolio can be 9% also. So plotting that, you know, plotting this multiple combinations, we can get something which is called as your efficient frontier. Now, what is your efficient frontier? Your efficient frontier is actually that particular combination of your securities in which we are generating higher returns at the same level of risk. Okay. So let's say, for example, a particular combination, let's say 70-30 combination has a risk of 10%, okay, and it has a return of, let's say, for example, 12%. And a combination of, let's say, 30% of A and 70% of B can have a risk of 10% and a return of, let's say, 18%. Now, in this particular case, if I plot this in a graph, then at 10% risk, one particular portfolio is providing me with a return of 12%, and at the same 10% risk, one particular portfolio is providing me with a return of 18%. So can you guys see that this portfolio A has same level of risk but higher returns as compared to the portfolio B, which is having the same level of risk but lower return? So A is efficient as compared to B. Come on, yes or no? Yes, sir. So while plotting this particular securities in the graph, we come to know that a particular portfolio is on an efficient frontier as compared to an inefficient frontier, right? So basically, when we calculate the risk and return of a portfolio using infinite possibilities of the weights, then when we plot this in a graph, we get something which is called as efficient frontier and inefficient frontier. So what is an efficient frontier? It provides the higher return at the same level of risk. An inefficient frontier means it provides lower return at the same level of risk. Okay, so when we are going to calculate the expected return of the portfolio and the risk of the portfolio, and we plot this in a graph, then we get something which is called as efficient frontier and inefficient frontier. Now, my dear students, we will always select the securities which are there. We'll always select the portfolios which are there on the efficient frontier. Come on, yes or no? Yes. Why? Because it always provides higher return at the same level of risk, right? So we never make investments in a portfolio which is on the inefficient frontier. Okay. But now, what is this least risk? This least risk portfolio is called as a particular combination of weights in which the risk is minimum. Okay, in which the risk is minimum. So you as a portfolio manager, suppose your objective is just to minimize the risk of a portfolio, then you will use the concept of least risk portfolio. So what will you do in this least risk portfolio? You will create that combination of weights in which the risk of the portfolio is going to be minimum, irrespective of whatever the returns are going to be. Okay, so this is also called as your minimum variance set as well. Now this least risk portfolio, my dear students, okay, here if you want to calculate weights of your security A, then we take whatever is going to be your variance of B minus your covariance AB, and we divide this by variance of A plus variance of B and minus your 2 times covariance AB. So this is the formula to calculate your weights of A, and if you want to calculate your weights of B, then that is 1 minus weights of A. Will that give you your weights of B? Yes or no? Yes, sir. So this is just one of the way to calculate your weights of A and weights of B in a least risk portfolio. And always remember this, that if suppose correlation coefficient will be given to you, then this covariance AB, can we substitute this by correlation coefficient AB into standard deviation A into standard deviation B? Okay, so this can also be substituted by correlation coefficient AB into standard deviation A into standard deviation B. Okay, so that depends upon the type of the data which is given to the question. So my dear students, whenever you see that we are required to calculate particular combination of a portfolio, a proportion of a portfolio in which the risk of the portfolio is going to be minimum, then we will use the concept of least risk portfolio. Okay, so just to summarize, my dear students, with two securities in a portfolio, can we create infinite portfolios with the same? Yes or no? Yes, sir. When we plot that in the graph, then we have something which is called as your efficient frontier and inefficient frontier. So this particular combination of the weights is called as your least risk portfolio. At this combination, the risk of the portfolio is minimum. But is it possible that your least risk portfolio can also touch the y-axis? Yes, it is possible. Which means that the risk of the portfolio can be zero as well. But that is only possible when there is perfect negative correlation. So always remember like this. Whenever there is perfect negative correlation between the securities, that is the relationship between the securities -1, then you have to remember that the risk of the portfolio can be eliminated. It can be zero as well. Okay. So my dear students, always remember like this, that if they give it to you, that let's say for example, the correlation coefficient between the two securities in a portfolio is -1, then what is the least risk portfolio? Then we can say that we can completely eliminate the risk of the portfolio as well, okay, at a particular combination of weights. So then the risk of the portfolio can be zero as well, but we need to check that at what proportion of the weights it can be zero. So that is something which we can calculate by using this formula, or else we can also calculate this by using the formula risk of a portfolio is weights of A into standard deviation A minus weights of B into standard deviation B, because whenever the correlation coefficient between the two securities -1, you know that we can use this shortcut formula to calculate the risk of the portfolio. I've derived this in the part 1 of the chapter. Okay. Now let this be 0. Then we can have this as x multiplied by whatever is the risk of your uh, standard deviation A, of your security A. We can take that into consideration. Let's say it's 10%. Minus this will be 1 minus x into this can be let's say 15%. And based on this, we can calculate your x and what is going to be this 1 minus x. So we'll be having this weights. Okay. So I hope you all have understood this concept, that least risk portfolio, when to use it, when we are required to calculate that combination of a portfolio in which the risk is going to be minimum. Okay. So this is the formula, and let's say in question number 37, P and Q have a low positive correlation coefficient, that is plus 0.5, and the respective risk and return profile is given to you. So where we have this as returns, and here we have risk, standard deviation P, standard deviation Q. Compute the portfolio risk of P and Q to minimize the risk. Okay, so here we are required to calculate what should be the weights of P and what should be a weights of Q. Okay, in which the risk of the portfolio is going to be minimum. Now here it is plus 0.5. It does not mean that here the risk of the portfolio can be zero, because there is no perfect positive or negative correlation. So that's why it's not going to be zero. But yes, there is going to be some minimum risk of the particular portfolio. So for that, what we have to do? So now, my dear students, we need to now use this particular formula. As you all can see, what is weights of A? Variance of B minus correlation coefficient AB into standard deviation B upon whatever is your variance of A plus variance of B minus 2 times correlation coefficient AB into standard deviation A into standard deviation B. So based on this, if we calculate, then we get this weights as 71% and 29%. Okay. Similar to this, in your question number 38, as you all can see, that your correlation coefficient is actually -1. So here the risk of the portfolio can be zero, because when it is perfect negative correlation, then you can completely eliminate the risk as well, and that can be zero. So in this particular case, you can use it by this formula as well, and you can get this as 55% and 45%. But also you can use, as I just now explained to you, you will be getting the same weights of 55% and 45% if you use this particular concept. Okay. So this is with regards to your question number 37 and question number 38. In your question number 39, now here also we are required to calculate what should be your weights for the least risk portfolio. So an investor has decided to invest rupees 1 lakh in the shares of two companies, ABC and XYZ. The projections of the returns from the shares of the two companies, along with the probabilities they have given to you, 20, 25, 25, 30, we have ABC, we have XYZ. You are required to comment on the return and the risk of investments in individual shares. So how do you calculate the returns? Okay, now to calculate the returns for individual shares, you have ABC, we have the probability, we can multiply that, and we can get what is going to be the expected return from the security ABC? Come on, yes or no? Yes, sir. That's very easy. We can simply take 12 into 0.2, 14 into 0.25. So what is the expected return? Okay, from the security A. So that is nothing but summation of probability into RA. Okay, so that is going to give you the formula and what should be the expected return. Similarly, for XYZ also we can calculate it accordingly. Okay, for risk of security A, I can use the formula whatever is going to be root of summation of probability into RA minus RA bar square. So on this basis, I can calculate the risk of the security as well. So same concept applies for XYZ. Okay. Compare the risk and return of these two shares with a portfolio of these shares in equal proportion. So now, my dear students, we are required to calculate what should be the expected return of a portfolio and what should be the risk of a portfolio. Now, this expected return of a portfolio, can I calculate by using the weighted average concept? Come on, yes or no? Yes, sir. So weights of A into average return of A plus weights of B into average return of B. So that will give me the expected return of a portfolio. But how do we calculate the risk of a portfolio? So my dear students, to calculate the risk of a portfolio, we need to have a interactive risk between ABC and XYZ, which is not available to you. So can we calculate covariance? Come on, yes or no? Yes, sir. And these covariance I can calculate because we have the future estimates available. So your covariance between ABC and XYZ can be calculated by taking summation of probability into RA minus RA bar, and that can be Rx minus Rx. So based on this, we can calculate your covariance between ABC and XYZ. Okay. So in this particular case, my dear students, if you just check, we have got what is your RA bar, then Rx bar, then as I told you, what is your risk of A, B, we have calculated that. And this is how we calculate the expected return of a portfolio and what is going to be the standard deviation of the portfolio. Okay, so exactly on the basis of the formulas which we have discussed. Now comes the third part, because in the third part of the question they have asked you, find out the proportion of each of the above shares to formulate a minimum risk portfolio. So we can calculate your least risk portfolio using this concept of weights of A, which is nothing but variance of B minus covariance AB upon variance of A plus variance of B minus 2 times covariance A. So based on this, we'll be getting weights of A and your weights of B. Okay. So always remember, my dear students, whenever they give you the question, you are required to calculate your least risk portfolio. Just make it a point that we calculate the minimum risk by taking into consideration this formula of weights of A and weights of B. Okay. Now, with this, my dear students, we are done with your question number 39. Now, let us first revise what is your arbitrage pricing theory. Okay. Now, my dear students, very quickly, arbitrage pricing theory, this can be used as an alternative to CAPM. Okay, so I'll just revise this for you. Now, whenever, my dear students, we are talking about your CAPM, how do you calculate your expected return? So, your expected return is RF plus RM minus RF into beta. Will this give you the expected return of the security using CAPM? Yes or no? Yes, sir. But in this particular formula, we know that RM minus RF, this is nothing but market risk premium, which we need to multiply by beta. So this together will give you your security risk premium, right? RM minus RF into beta. So RM minus RF, this will be called as your market risk premium, which we multiplied by beta. So can I say that will be called as your security risk premium? Come on, yes or no? Yes, sir. So if I want to calculate the expected return, I can take the risk-free rate and add, whatever is the market risk premium multiplied by beta. So we know that in your CAPM model, we are actually having one particular risk premium which we multiplied by beta. Okay, so it's called as a single factor theory. But in your arbitrage pricing theory, we call it as a multi-factor theory. Why? Because we take whatever is the risk-free rate plus whatever is going to be the different factors risk premium which we need to multiply by beta. So as we know that one of the factor is market risk premium which we multiplied by beta, right? So we call this market risk premium as lambda 1 which we multiplied by beta 1. Then also there can be lambda 2 which can be multiplied by beta 2 plus lambda 3 multiplied by beta 3 plus lambda n multiplied by beta n. Because this particular model of APT is based on the concept that a security's return is just not based on one particular factor. It is based on multiple factors. Okay. So when we are expecting the return from a security, it is just not based on one single factor. It is based on multiple factors. Like, can I say GDP data? Can that have an impact on the return of a security? Yes, sir. Can we say that interest rate risk that can have an impact on the return of a security? Yes, sir. Can we say that inflation that can have an impact on the return of the security? Yes, sir. So basically, my dear students, there are so many multiple factors which have an impact on the return of the particular security. Okay. So we need to check that, let's say, the difference between actual and the expected data, that is called as the risk premium. So let's say that you are expecting that the inflation rate should be 10%, but the actual data tells you that the inflation rate is 15%. Then what is the risk premium? 5%. So this 5% of the risk premium, we call it as lambda 1. Now we need to multiply this by beta 1. Now what is beta 1? That how is this stock sensitive to the inflation rate risk? Now if suppose the stock is very much sensitive, if it's an FMCG company, so for FMCG company, inflation plays a very important role. If the inflation keeps on increasing, then these type of companies gets affected the most. So it is very much possible that they are going to have highest sensitivity to such kind of risk premium. So we will multiply that with whatever is your beta 1. Similarly, whatever is your lambda 2, the difference of, let's say, interest rate risk. So interest rate risk, we need to check that, let's say actual data was 18% and the expectation was 17%. So 1%, that's your interest rate, which we need to multiply by the beta 2. So that is how each and every risk premiums, we need to multiply it by your beta to get what is going to be that particular security risk premium, which we added to the risk-free rate. So the difference between your CAPM and arbitrage pricing theories, your CAPM is nothing but your single factor model, where we just take it into consideration whatever is going to be your risk-free rate plus your individual risk premium. Okay, that is market risk premium, RM minus RF, which we just need to multiply by beta. But in arbitrage pricing theory, we have to understand only risk-free rate doesn't, only one particular factor doesn't affect the securities return. If you want to expect the security return, we need to check that what are the different factors, macroeconomic factors, which have an impact. Okay, so those macroeconomic factors, those risk premiums, we denote it by lambdas, and how the stock is going to react to that particular macroeconomic factors, we consider that as beta. So then it is possible that we take into consideration lambda 1 into beta 1, lambda 2 into beta 2. And it is very much possible that for some macroeconomic factors, the stock can be insensitive as well. So in that particular case, the beta can be 0 as well, okay, for that particular macroeconomic factor. So we need to check that what is going to be all these risk premiums added to the risk-free rate to get the expected return. So my dear students, the conclusion is that when we want to calculate the expected return as per your arbitrage pricing theory, we have to take the risk-free rate and then add lambda 1 into beta 1 plus lambda 2 into beta 2 plus whatever is your lambda n into beta n. So that is how the expected returns will be calculated. Okay. Now, my dear students, let us start with the questions of APT. Very quickly, we'll revise it. In question number 40. Now, see what is given to you. That Tamarind intends to invest in equity shares of a company, the value of which depends on various parameters which is mentioned below. So we have factor GNP. Okay, so this is gross national product, inflation, interest rate, stock market index, and industrial production. Now, are you seeing how Tamarind is sensitive to this macroeconomic factors? For this particular data, for this macroeconomic factor, Tamarind is sensitive to 1.2. For inflation, it is sensitive to 1.75. For interest rate, it is sensitive to 1.3. So this is beta 1, this will be beta 2, beta 3, beta 4, beta 5. So there are 5 macroeconomic factors. Okay. Now, do you have the actual value and expected value? Yes. So this will help you to calculate your lambdas. So in the first factor, we know that the lambda is 0. So there is no risk premium. So that is why 0 into 1.2. So anyway, it will not be added. Okay. So that is why, in this question number 40, in the first particular case, okay, in your first macroeconomic factor, that is GNP, your actual and expected. What's your actual? It is 7.7. What is our expected? 7.7. So we know that this is 0. Okay. Then what's the next part? It is inflation. Now in inflation, you all can check what's the actual. The actual is 7 and expected is 5.5. So 7 minus 5.5. So the risk premium is 1.5. Okay. Then for your interest rate, what we need to do similarly, we'll be taking 9 and this is 7.75. 9 minus 7.75. So this will be 9 minus 7.75. So that will be 1.2. Similarly, we have the next one, that is stock market index. So for stock market index, we have the actual data of 12 and 10. Okay. And this will be treated as 2. And then what do we have next? Industrial production. So your industrial production will be 7.5. And from this, if I subtract 7, so this will be 0.5. So all these are your risk premiums. What are we going to do? We'll multiply that by checking that how much sensitive it is. So it is 1.2, then it is 1.75, then it is 1.3, then we have 1.7, and the last one is 1. So can I say now, if I add all these things, I'll be getting the total risk premium. So this will be 0, 1.5 into 1.75. Then 1.28, we need to multiply that by 1.3, 2 into 1.7, and then we have 0.5 into 1. The total of this is 8.189. To this, I need to add the risk-free rate. What's the risk-free rate? It is 9.25. So if I add the risk-free rate of 9.25%, then will I be getting what is going to be your 17.44%, the expected return from the security. So my dear students, this is how we are going to calculate the expected return as per arbitrage pricing theory. Very simple concepts. So we need to take into consideration lambdas and multiply that by betas, and then whatever is the risk premium, you add it to the risk-free rate, and ultimately we'll be getting the expected returns. Okay. Now, one question I want to do it with pertaining to your question number 41, which is your short selling concept. Okay, so based on this, we'll be doing it. So first, how to determine the weights here, that is something which is very important. So let's check this out. Mr. X owns a portfolio with the following characteristics. So we have here factor 1 sensitivity. Okay, so that's nothing but the beta to factor 1. Security A reacts as 0.8 to factor 1 sensitivity. Now this factor 1 can be anything. It can be GNP, industrial production data, interest rate risk, anything. Okay, so security A is sensitive 0.8. Okay, then security B is sensitive 1.5. Similarly, here this is sensitive 0.6. This is sensitive 1.2. Okay, and then we have the expected returns, which is readily available. Now, very quickly, you all can understand that your beta for this security C is 0. What does it mean? That it is completely unrelated, right? Similarly, this is also 0, so that is also completely unrelated. So security C is having no, on whatever is going to be the changes in the factor 1 and factor 2. Okay, so it is completely unaffected by the same. It's insensitive. So can I say that this security C is nothing but the risk-free security, right? 10% is actually the risk-free security because it is insensitive to the factor 1 and factor 2 sensitivities. Okay. Now, it is assumed that the securities returns are generated by two-factor model. If Mr. X has rupees 1 lakh to invest and sells short 50,000 of security B and purchases 1,50,000 of security A, what is the sensitivity of Mr. X portfolio for the two factors? Now, my dear students, in this particular question, we are required to calculate that what is the sensitivity of Mr. X portfolio to the two factors. Okay. So basically, we need to calculate what should be the beta of the portfolio to factor 1 and what is the beta of the portfolio to factor 2. Okay. So we have to calculate beta of the portfolio. How sensitive is this portfolio to factor 1 and how sensitive is this portfolio to factor 2? So you must be wondering, sir, we used to always take in CAPM only one thing. That is the portfolio was actually sensitive So we used to just calculate weighted average beta to only one factor. That was market risk premium. Here, my dear students, it's completely different. Here we are required to calculate the beta of the portfolio to factor 1 as well as to your factor 2. So how do we do that? So in that particular case, your beta of the portfolio actually can be nothing but, can I put it like this? It is nothing but weighted average. Okay, so we are having security A and security B, but here they have told you that Mr. X intends to invest 1 lakh and sell short 50,000 and purchases 1,50,000 of security. So mind you, my dear students, we actually have 1 lakh rupees with us. So with that 1 lakh rupees, we can actually invest in security A 1 lakh. But what Mr. X wants to do, it wants to sell short 50,000. So when we sell short 50,000 of security B, with that credit, can we invest more in your security A? Come on, yes or no? Yes, sir. So in short selling, we have to understand this concept that whenever we are selling short a particular security, that gives us the credit which we can use it for the purpose of investment in another security. So that is why we are short selling B. We got this credit of 50,000, which we are using it for the purpose of investments in your security A. So that is why now your security A investments is going to be 1,50,000. So what will be your weights now? So it is 1,50,000 of security A, 50,000 of security, because see, ultimately though we have 1 lakh rupees only. So that is why your weights will now be 1.5, negative zero point 0.5 and 1. And now what will be the beta? So for your factor 1 sensitivity, we know that security A has beta of 0.8 and your security B has beta of 1.5. So will this give you your weighted average beta? Come on, yes or no? Yes, sir. 1.5 into 0.8 and then 0.5 negative into 1.5. So this will eventually give you some 0.45. Okay. So is this 0.45 going to be your portfolio beta to factor 1 sensitivity? Yes, sir. Similarly to factor 2 sensitivity, it will be the same weights, but now the betas will be changed to your factor 2. Okay. So that is how we'll be calculating in the first part what is going to be the beta of the portfolio. Okay. To show you the solution for this, let me just see if I have it right now. Uh, okay, great. So as you all can see, we can have the weighted average beta of the portfolio using this 0.45. And similarly for your second portfolio, we can have this as 0.35 for factor 2 sensitivity. Okay. So that is going to be your 0.35 or 0.3, something like that. Okay. Now 0.3. Now, my dear students, what's the second part? If Mr. X borrows rupees 1 lakh at the risk-free rate and invest the amount he borrows along with the original amount of rupees 1 lakh in security A and B in the same proportion which is described, what is the sensitivity of the portfolio? Now, my dear students, in the second part, see what is happening in the second part. In the second part, we are now investing in security A in the same way as we have done it in the first part, but here we are borrowing rupees 1. Now, borrowing rupees 1 lakh is very similar to, can I say that we are short selling security C? Why I'm telling you this? Because if you are short selling security C, then definitely the expected return of 10% that will become your cost. See, because whenever you short sell a security, it means that you have sold it at a particular rate and then you have to buy it at a lower rate. That was the intention. But if that security is providing you with the returns, it means that the whatever is the returns of the security, that becomes your cost. So let's say, for example, I have undertaken a short position in Reliance. Okay. But if Reliance gives you a return of 10%, it means that that's my loss. So that's the cost for me. Right. So similar to that, if your security C, we are short selling it, or let's say, for example, we are borrowing only 1 lakh rupees. Okay. And the rate of interest is nothing but the risk free rate, that is 10%. Then how much is the amount which needs to be taken into consideration? So here we can do it like this: A, B, and loans. Okay. Or else you can also write down security C, which we are short selling it. See, we are ultimately having 1 lakh rupees only with us. because our money is just 1 lakh rupees. So in the first scenario, what did we do? We bought 1,50,000 of A and we had a short sale of 50,000, right? Now we are again taking a loan of 1 lakh. But what are we doing with this 1 lakh? Okay, so taking a loan or short selling C will result in a negative 1 lakh rupees. Now this 1 lakh rupees, what are you doing? We are actually utilizing this 1 lakh exactly how we utilized in the first part. And in the first part, how did we utilize this 1 lakh? We bought 1,50,000 of A and we had a short selling of 50,000 of B. So because of this, as you all can check, now your amount invested will be 3 lakhs in A, then it will be 1 lakh in B, and then it will be 1 lakh here. So together, can I say we are just having 1 lakh rupees here? Come on, yes or no? Yes, sir. So this is very tricky because that's why I always explain to my students like this, that instead of taking borrowings, you can also understand like this, that security, see, we are short selling it. So then 1 lakh rupees is short sale. So 1 lakh is negative 1 lakh in your portfolio. And with that 1 lakh, now you're utilizing in the same way as you did it in the first part. So we took 1,50,000 of A and that 50,000 was negative. So that's how 150 plus 150 is 3 lakh. And for your B, it is negative 1 lakh. And for your security C, it's 1 lakh. So this is how your weights will now be 3, minus 1 and minus 1. This is 1. And now whatever is your weights, we have already got it. We have to take beta. So that's how we'll be getting beta for the first factor and the second factor. And we have to do that accordingly. All right. So this is your second part. Okay. So I just wanted you all to understand that we can do it like this. And third, what is the expected return premium of factor 2? Okay. Now this expected return premium means we are required to calculate lambda 2 is what? Okay. Because they have told you what is for the factor 2. So for this, my dear students, we will use one equation and we'll do that accordingly. Okay. See, what is the expected return which they have given to you? Expected return is 15% for security A, okay, and that is RF plus lambda 1 into beta 1 plus lambda 2 into beta 2, okay. So we have got this as your equation 1. This is your equation 2. We have to solve this simultaneously. So you'll multiply equation 1 by 1.5 and equation 2 by 0.8. So then your lambda 1 will be cancelled and then you'll be left with your lambda 2. And based on that, this will be nothing but 8.33%. So this is how the calculation will be done. Okay. For your third part. So we are required to calculate the expected return. By using this formula, you can just pause this video for the timing. And if you want to solve it, you can solve this on your own. So we were required to calculate your lambda 2. So we have done this accordingly. Okay, so your lambda 2 will be calculated like this. Now, my dear students, with this, now we can say that your third part is also completed. What is the expected return premium for factor 2? Now, question number 40 to 43 is based on the similar lines. Question number 44, here also, my dear students, it's a concept of arbitrage pricing theory, because as you all can see, this is your factor 1. Okay. So here you all can see that there are 3 factors, factor 1, factor 2, factor 3. And these are the sensitivities. Okay. These are the sensitivities of the stocks with each of the factors. We have the risk premiums available. So we actually have lambda 1, we have lambda 2, and we have lambda 3. Using the arbitrage pricing theory, we are required to determine the expected return, okay, on the market index. So how will we calculate the expected returns? So expected returns here, we can calculate by using 2 concepts. The first one is that we take weights of, because there are 4 stocks in this index. So we can take weights of A into whatever is the average return of A, plus weights of B into whatever is the average return of B, plus weights of C into average return of C, and plus whatever is your weights of D into average returns of D. So based on this, we can actually calculate your expected return on the portfolio. Okay. And how do we calculate the returns of each and every security? So this returns of each and every security, my dear students, we can calculate this by using an arbitrage pricing theory. So by using your APT. So using your arbitrage pricing theory, we can calculate what is the expected return for A. So that can be calculated by taking RF plus lambda 1 into beta 1 plus lambda 2 into beta 2 plus lambda 3 into beta 3, and these are the three factors. So we have the RF available, which is 4.5%. So we can take 4.5 plus what is your lambda 1? 6.85. So we can take 6.85 multiplied. I'm just showing you that how we can calculate the expected return for each and every security. So for small cap growth, you know that it is 0.8. So I can multiply this by 0.8. What's my lambda 2? It is negative 3.5. So I can take negative 3.5 and I can multiply that by beta 2, which is nothing but 1.39. And then we can take lambda 3. So your lambda 3 is 0.65. And I can multiply the same with your beta 3, which is nothing but 1.35. Right? So based on this, can I calculate the expected return of A? Yes, then I can multiply this here. So we can get, because we already have the weights available, 25, 10, 50 and 15. So then we can calculate the expected return of the portfolio using this particular concept. We can calculate the expected return of each and every security and multiply that by the weights, we can get the expected return. But also you can do it by another method as well. What is another method? We can simply calculate what can be the beta of the portfolio to factor 1, factor 2 and factor 3. And once we have the weighted average beta for each and every factor, we can multiply that by the respective lambdas and add the expected return, risk-free rate. We will be getting what is the expected return of the portfolio. So any one of the two methods you can do it. So in that particular case, what will be expected return of a portfolio? Then that is nothing but RF plus lambda 1 into beta of portfolio to factor 1 plus lambda 2 into beta of portfolio to factor 2 plus lambda 3 into beta of portfolio to factor 3. So how will you calculate beta of portfolio to factor 1? So we will be simply taking into consideration whatever is the weights, you multiply that by beta, sum it up. So that is how we'll be getting beta of portfolio to factor. So this is the faster way to do it. Instead of taking each and every security returns and then doing weighted average, you can also do it like this. The answer is anyway going to be the same. Okay. And then we have to use CAPM. So for CAPM, we'll use factor 1 because that's the beta which they have given to you in the question. And Mr. Nirmal Kumar wants to consider a portfolio of only small cap value and large cap. If the target beta is 1, determine the composition of the portfolio. So here we are required to calculate the weights when the beta of the portfolio you want to keep it as 1. So based on that, what should be the composition? So let the weights be X and we have to do it accordingly. So this is now very similar to what is your beta of the portfolio. So your beta of the portfolio is weights of A into beta of A, right? Then weights of B into beta of B, right? Now in this particular case, we are just taking two securities in the portfolio, small cap and large cap. So small cap and large cap, we have their individual betas available as 0.9 and 1.165, 0.9 and 1.165. Okay, and let this weights be X. So this will now be 1 minus X. So we want the beta of the portfolio. This beta of the portfolio, my dear students, we want to keep this as 1. Okay. So for this, what should be your X? And we'll be getting weights of A based on this. And then 1 minus X will be getting weights of B. So this is how, my dear students, we can do the calculation for your beta of the portfolio. Okay. So this is how, my dear students, we'll be calculating your weights of beta of X and weights of beta and weights of A and weights of B as well based on this particular concept. Okay. Now, my dear students, we'll be starting with your performance evaluation measures. Okay. So now in this performance evaluation measures, first of all, what's the objective of this concept? The objective is very simple, that a portfolio manager is going to have multiple portfolios in front of him. Is he going to invest in all the portfolios? Then the answer is no. Is he going to select the best possible portfolio? Yes or no? Yes, sir. So now when he's going to select the best possible portfolio, he needs some measurement techniques to evaluate the performance of the portfolios. So that is why in this concept, you are going to learn that there are three types of measurement techniques. Okay, how many types of measurement techniques are there? There are three types of measurement techniques. So basically, there are three types of ratios: Sharpe ratio, Trenor's ratio, and Jensen's alpha. So in your Sharpe ratio, you all can see that there is premium over risk-free rate, which we divide that by the total risk, and this total risk, will be called by the way of standard deviation. So whenever you are measuring the performance of a portfolio based on the Sharpe's ratio, just make sure that we are taking into consideration premium over risk-free rate and dividing that by the standard deviation. Trenor's ratio has the same concept, premium over the risk-free rate. But we are dividing that with what? We are dividing that by the systematic risk, which we measure with the help of beta. And for Jensen's alpha, we take alpha is equal to RA minus your CAPM. So that gives you your Jensen's alpha. So apparently there are three basic types of performance evaluation measures. The first one is your Sharpe's ratio, the second one is your Trenor's, and the third one is your Jensen's alpha. So for Sharpe's ratio, what are we going to do? We'll be simply taking over consideration premium over the risk-free rate. So how much is the fund or the portfolio giving you the returns which we subtracted by the risk-free rate? Suppose your return of a portfolio is 15%, risk-free rate is 10%. So can I say 5% is higher? So with this 5%, we divide that by standard deviation or the total risk. This will give you your Sharpe's index. When it comes to Trenor's ratio, we take this particular premium, that is RA minus RF, and we divide that by systematic risk, that is beta. And for Jensen's alpha, whatever is the returns of the portfolio, we subtract it with the CAPM return. Okay. So if they just ask you, in the MCQs that whenever there is a sector specific fund, so which is the better way to measure, then it's always the Sharpe ratio. And whenever there is a well diversified portfolio, then the Trenor's ratio. Okay. Why? Because whenever we are taking your Sharpe's ratio, always make it a point that in a sector specific, let's say for example, we are talking about automobile industry. So if we have built up a portfolio of auto stocks, then in this particular case, we have not diversified it, right? Because we have just invested our money only and only in auto stocks. So there is no diversification per se. So in this particular case, to measure the performance of this particular fund, we should always take the total risk, that is standard deviation. But guys, if it's a well diversified portfolio where there is auto, real estate, etc., then we can simply take beta and take that by the way of Trenor's ratio and do that accordingly. Fine. So these are the formulas for the same. So for Sharpe, always remember that we are going to divide that by the standard deviation. And for your Trenor, we are going to take into consideration your beta. Okay. And obviously, all these performance evaluations should be higher the better. And based on that, we are going to give them the rankings. Okay. So now let us quickly revise the questions on this. Now these are relatively easy questions, so I will not take much of your time in just performance evaluation measures. See guys, what is given to you that ABC has a beta of 1.2 and the risk-free rate is 8% and RM is 15%. What is the required rate of return on the shares of ABC? And if the actual returns for the 4 observation is this, then what is the Jensen's alpha for the share? So we have the actual returns. We can very easily calculate your Jensen's alpha by first we will take expected return on the base of CAPM, and we have got this as 16.4. Then from the actual returns, if you subtract the CAPM, what we get is nothing but the Jensen's alpha. Or else if you want, alternatively, you can also do it like this. We can take the actual returns, and these actual returns, we can divide it by 4, we'll be getting the expected return, and then compare that with Jensen's alpha as well, and see what is, compare that with the expected return as per CAPM and see that what is going to be your Jensen's alpha. So any one of the two ways is okay. Okay. So this is how we can do your question number 45. Now, let's say for example, question number 47. Now see in 47, what is given to that the risk-free rate is given to us 10% and with the market portfolio having an expected return of 20% with a standard deviation of 8%. What is the Sharpe's index for the portfolio X with a mean of 14%, the standard deviation of 18%? For portfolio Y, having a return of 20% and standard deviation of 16%. So currently we are required to calculate the Sharpe's index. So whenever we are talking about Sharpe's index, what's the formula? We have to consider actual return minus the risk-free rate, and we are going to divide that by the standard deviation, right? So that is nothing but your very simple Sharpe's index. So in this particular case, as you all can see, Sharpe's index is your actual return minus risk-free rate upon standard deviation. And as you all can see that we have portfolio X, portfolio Y, we have the risk-free rate, we have RM, we have standard deviation. So we also have for portfolio X the expected return on the portfolio and their standard deviations is available. So basically for portfolio X, as you all can see, that 14% is the return which is provided by the portfolio. Is it providing you the premium over the risk-free rate? Yes, that is 10%. So then there is a premium which we divided by 18%, so you'll be getting 0.22:1. So that's the first part. Then also simultaneously, if I'm talking about portfolio Y, we are having this as 20% and this is 16%. So, and your risk-free rate is 10%, so your premium will be 20 minus 10, and we are going to divide that by 16, so this will be 0.625. And for the market, we can do it accordingly. So this is how we can calculate these portfolio valuations, okay? And then we have to give the conclusion based on this. So always remember that all these ratios should always be higher the better, okay? So we always want to earn more premium per unit of risk, okay? Question number 48. Now, this can be a little bit important from the examination perspective. Here we have portfolio A, B, C, D, F. We have the market, we have average annual returns, we have the standard deviations, and also we have the correlation with market, and we also have the risk-free rate. So we are going to rank these portfolios using Sharpe's and Trenner's method. So how are we going to do this? Okay. So my dear students, when it comes to your rankings, okay, first for Sharpe's index, as you all know, what is it? It is RA minus RF upon standard deviation or the risk of the particular portfolio. Okay. So for every portfolio, we can calculate, we have the actual return, which is 18.6. And then we have the risk-free rate of 9. And that is something which we divide by the standard deviation, which is 27. Okay. So this is how we can calculate 0.36, 0.32, 0.76. For every particular portfolio, we can calculate what is going to be the Sharpe's index, and then we also have the ranks available. Higher the better, so that's why we'll be taking rank 1, rank 2, and we'll be allocating the ranks based on this. Similarly, my dear students, for Trenner's index. Now for Trenner's index, we have RA minus RF, and we're going to divide that by beta. So here beta is not readily available, but guys, don't worry, we have the correlation with the market. So we know that what is the correlation of the portfolio with the market, and we also know that what is your risk of the portfolio and risk of the market. So can we calculate the beta? We can calculate the beta by taking correlation of the portfolio with the market into standard deviation of portfolio upon standard deviation of market. Come on, yaar. We have already revised this. So in this particular case, do I have the correlation with the market? Yes, sir. Do I have the standard deviation and of the portfolio as well as the standard deviation of the market? And based on this, we can calculate it. So we'll be getting your portfolio A, B, C, D, E. We can get the Trenner's index. And first step is we have to first calculate the beta. And then this beta will be used for the purpose of dividing it. And then we will be eventually getting the Trenner's index. And we can also give the rankings on the same. Okay. Also at the same time now, we have this rankings and we have Sharpe's index and we have Trenner's index. So here this is how we can calculate it. And then is there any reason for the difference in the rankings? Yes, because your Sharpe uses total risk, whereas Trenner uses systematic risk. So this is one of the questions which you all can revise it. Okay. 49 is not that important. It's fine. 50th question. Okay. Now this is something which we need to revise. Question number 50 is a very comprehensive question. It takes into consideration many things. If you can solve this, then it's the best particular question, okay, which can give you complete analysis, okay, of how to approach, what is the variance, etc., everything. So it covers so many things: systematic risk, performance evaluation, beta of the portfolio, etc., etc. So this is a very good question to practice, okay. Now question number 50, let's read this. Mr. Abhishek is interested in investing rupees 2 lakhs, for which is considering the following three alternatives. So guys, we have investment of rupees 2 lakhs in mutual fund MFX. We have 2 lakhs in MF5. And the third part is we can invest 1 lakh 20 in MFX and 80,000 in MF5. So basically, if you have 2 lakh rupees, there are three options available. The first option is you invest the entire 2 lakh rupees in mutual fund X. The second option is you invest the entire 2 lakh rupees in mutual fund Y. And the third option is you invest 1 lakh 20 in X and 80,000 in Y. Okay, so these are the three options, right? Average annual return earned by MFX and MFI is 15 and 14% respectively. The risk-free rate is 10% and the market rate return is 12%. Covariance of returns of MFX, MFI and market portfolio mix is given to you. So we have this portfolio mix. Now, see guys, what is this mix? Now, as you all know that market portfolio mix actually means what? It means Nifty. Okay. So they have given you Nifty data. They have given you MFX. They have given you MF5. Okay. And now we are required to calculate what is the variance of the return from MFX, MFI and market return. What is the portfolio return, beta, portfolio variance and portfolio standard deviation. What are the expected return, systematic and unsystematic risk and sharp, trainer and alpha. So all these things we are required to calculate. Okay. See, first of all, what is given to you? Basically, see, the data which is given to you is slightly in a very different format. As you all know that covariance is given to you. So there is a matrix which is given to you. Now see, let me put it like this. There is mutual fund X, okay, Y, and market, mix, okay. Now my dear students, if you want to know the correlation coefficient of the mutual fund X with mutual fund X, don't you think it is going to be +1 only? It is going to be perfect positive correlation because mutual fund X with mutual fund X, it's always going to be perfect positive only. My dear students, very simple concept that your mutual fund X with mutual fund X, this has to be perfect positive correlation, so it has to be +1. They both are going to move exactly in the same direction. The correlation between RIL with RIL has to be perfect positive correlation only. That is going to be +1. Then the correlation between mutual fund Y and mutual fund Y, that is also going to be +1. The correlation between mix and mix, that is also going to be +1, obviously. Okay. So my dear students, we know that the correlation coefficient amongst its own self is always going to be +1, +1, +1. Okay. But they have given to you covariance. Now this is covariance of X with X. This is covariance of Y with Y. And they have given you covariance of Y mix with mix. Right? Mix with mix. So this is the matrix. Okay. First, second and third. Then they have given you covariance of Y with X. Then they have given you covariance of X with Y. Then there is covariance of mix with X. Then there is a covariance of mix with Y. This is covariance of X with mix. And this is covariance of Y with mix. Okay. So basically they have given you this matrix. But the most important emphasis should be placed on that we know that the covariance. What is covariance? Joint deviation. So let's say, for example, if I talk about covariance of AB, once again I'm revising. This is nothing but joint deviation of RA minus RA bar into RB minus RB bar, isn't it? So it's the joint deviation between RA minus RA bar and RB minus RB. So when we are dealing with your joint deviation of MFX and MFX, this is nothing but, you know, the joint deviation of whatever is the return of MFX with its average, right? And which we are multiplying it by whatever is your MFX with its average, right? This is how we are going to calculate the covariance. Now, the first part of the question they have asked you is what is the variance of return? Now, how are you going to calculate the variance? So, I have just now analyzed that you know that the correlation coefficient of the fund with its own self has to be +1 only. Now, what's the formula for correlation coefficient of your, you know, A with B? So, can I say that is nothing but covariance of AB upon standard deviation into standard deviation B? Is this the formula for correlation coefficient of AB upon yes or no? Yes. Covariance AB upon standard deviation into standard deviation. Right? Now, the same thing, my dear students, if I want to calculate with the help of only for A with A, correlation coefficient of A with A, then this will become covariance of A with A upon standard deviation into standard deviation A. So my dear students, if this is A with A, then this will now become covariance of A upon variance of A. Because standard deviation is nothing but variance of A, right? So based on this same concept, if I know what is the correlation coefficient of mutual fund X with your mutual fund X, so I need covariance of mutual fund X with mutual fund X upon what is the standard deviation of mutual fund X square, that is variance, right? Because both of them are going to be the same. So now we know that this is plus 1. The correlation coefficient of fund X with its own self is always going to be plus 1. Do I have the covariance of X with X? Yes. How much is that? 4.8. So this is 4.8. Let this be X. So can I say that your variance is coming as 4.8? Yes or no? So this is how we are going to calculate the first variance. So the first part of the question, what is the variance of MFX, MFY and market return is right in front of you. This is the variance. Are you guys trying to understand? Okay. So this is your variance. Now the second part is what is the portfolio return? So you must be wondering, sir, what's the portfolio which we are creating? We are creating one portfolio na, by taking 1,20,000 in X and 80,000 in Y. So we have this weights available. So basically, how do we calculate the expected return on a portfolio? It's nothing but weighted average return, right? Weights of X into average return plus weights of Y into average return, right? So we have the weights available. We also have their respective returns available. So we can very easily calculate what is going to be the returns as well. Okay. So I'm presenting the solution in front of you. So if you want at any particular point of time, you can just pause this and solve it. This was your first part. As I just now told you that this will be the variance of the returns. Okay. Then this is going to be your second part, in which the first thing they have asked you is what is the portfolio return. So your portfolio return, my dear students, can be calculated like this, where we have expected return weights of MFX into average return plus weights of MFI into average return, and this is how we calculate it. Okay, this is the first part of this second case. Then what is going to be the beta? Okay, as you all know, what's beta? Beta of the portfolio is nothing but weighted average beta of the individual securities in it. So here we are investing in MFX and MFI. So if I have the beta of MFX and MFY, automatically I know that what is going to be the weighted average beta, right? So very simply we can calculate this. So my dear students, when we are going to deal with your beta, okay, so what is the beta of the portfolio? Weights of X into beta of X plus weights of Y into beta of Y. Okay. Now, how do you calculate your beta of X? So, beta, calculation of beta. Can I say beta of mutual fund X with market will be covariance of X with market upon market variance? Is this the formula which we can use it for the purpose of calculation of your beta of mutual fund X? Come on, yes or no? Yes, very easily. So we can take covariance of the mutual fund X with the market. So as you all know, mutual fund X with the market, we have this as 3.370. Okay. So we can take this as 3.370. And what is the market variance? It is 3.1. So this will eventually help you to calculate what is going to be the beta, which is 1.09. So we can have the beta of 1.09. Can you see the beta is 1.09? Similarly, the beta is 0.9. And once we calculate this on weighted average basis, so we can get your weighted average beta of the portfolio, which will be nothing but 1.104. So this is going to be your second part of the question. Okay. Now what's going to be the third part? Here only, what is the portfolio variance and portfolio standard deviation? So if we calculate portfolio variance by using modern portfolio theory, so we can just take that and take the root of it. So that will give you portfolio standard deviation. Now, in this particular case, there should be interactive risk between the securities in the portfolio. So between MFX and MFI, there has to be interactive risk. Do you have that interactive risk between MFX and MFI? Yes. As you all can see, that MFX with MFI is 4.3. So this is the covariance which is readily available. So it's very important for us to now understand, okay, that we can calculate this by using your MPT, and this will give you finally 4.472, and if I take the root of it, we'll be getting the portfolio standard deviation also, which is 2.1147. So this is your completion of the second part of the question, in which there were 4 subparts. So we have revised each and everything very clearly here. Okay. I hope you all are okay with this much part. And then what is the expected return, systematic risk and unsystematic risk. Okay. Now, how do you calculate the expected returns? So in this particular case, as you all are aware, that expected return can be calculated when we have beta. So RF plus RM minus RF into beta. So we can calculate the expected return of MFX, of MFY, and of the portfolio itself, because we have beta of all the three elements. So it makes it very simple for us to calculate what is going to be the expected return. So for your MFX, as you all can check your RF plus RM minus RF into beta. So you have the RF, okay, you have RM minus RF, you have the beta. So based on this, we'll be getting 12.18, 11.8, and 12.03. So these are nothing but your the expected returns, okay, for your CAPM. And what is going to be the systematic risk? So systematic risk, I have calculated on both the cases, that is based on standard deviation also and based on variance also. So institute usually prefers based on variance, okay, but I leave it up to you. You can do it on based on of your standard deviation also and based on your variance as well. So how do you calculate your systematic risk? So we take into consideration whatever is your variance, whatever is the standard deviation of the market, we multiply that into beta. So based on this, we'll be getting what is your systematic risk. What is the systematic risk based on variance? So we have the standard deviation of the market, the risk of the market. Okay. So risk of the market is, this is nothing but the variance of the market. So you can simply take 3.1 and take the square root of it. So we'll be getting the risk of the market, which is 1.76. We can multiply that by the beta. And what is your unsystematic risk? So as I've just now told you, that unsystematic risk, my dear students, there is no need for any measurement. It's simply your residual risk. So what we need to do is we have to take into consideration, very simply, from the total risk, we have to subtract the systematic risk. So we'll be getting the unsystematic risk and we'll be getting the final answer. Okay. So this is how, my dear students, we are going to calculate your systematic, unsystematic risk and everything. And then in the last part, they have told you that what is a sharp, trend, and alpha. So in this particular case, if you want to calculate sharp, trend, and alpha and your Jensen's alpha, so for MFX, MFI, and for the portfolio. So what is the Sharps ratio? We take into consideration premium per unit of risk. Per unit of risk here is your standard deviation. And for your beta, we already have calculated in the above part. We have the betas of all the three cases readily available. And then, my dear students, your Jensen's alpha. Okay. So Jensen's alpha can also be calculated accordingly. So I hope, my dear students, you all have understood this much part. And then we can give the rankings based on this particular part. Okay. So with this, my dear students, I can say that your performance evaluation measure is also completed. Okay. So I think everything regarding the performance evaluation measures, almost everything we have revised it very thoroughly. Just go through that. If it comes in the examination, one type of bonus question only. Okay. Now, my dear students, we'll be doing calculation of risk of a portfolio when MPT cannot be used. Okay. Now, my dear students, what are the situations in which we will not be considering your MPT? Okay. So based on that, now I'll be teaching you. So I just want you all to pay attention very thoroughly. Now see, my dear students, okay, uh, for a four security portfolio, okay, for a four security portfolio, we know that, using the concept of MPT will be very, 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 very difficult. You know why? Because there is going to be each pair, interactive risk of each pair. So there is going to be approximately 16 combinations for the same. Okay. So basically for a two security, we had four combinations. For a three security, we had nine. So for, a four security, there will be 16 interactive risk, and which is very difficult to calculate in the MPT. So we can use this Sharps index model or single index model, where what is the risk of a portfolio? It's nothing but the weighted average risk, of your systematic and unsystematic risk. Okay. So basically what will be given to you now is there will be total risk of each and every security, LMNK. There will be total risk. What is total risk? Total risk is nothing but systematic plus unsystematic risk. So that together will give you a total risk. And once we have the total risk available, we can take multiply that by weights and calculate the weighted average risk. Okay, so that is how we can calculate the total risk of the portfolio. Okay, so this is there also in your study module, where for the first time they have given you unsystematic risk in the question itself. So we have this random error, we have this unsystematic risk, we have this epsilon available with us. So this unsystematic risk is available with us. We can calculate systematic risk because we have beta of each and every security, and we also have the risk of the market. So risk of the market, if I multiply it by beta, I'll be getting systematic risk. I have unsystematic risk, I can add it, I'll be getting the total risk. We can take weights and then take the weighted average risk. That will be your total weighted average portfolio. Okay, so that is something which you're going to now learn in your question number 51. So you can recollect or you can understand that in your examination when to use this concept. When they give it to you in the exam itself, that the random error is this or the unsystematic risk is this. And also if they give it to you that use Sharpe's index model or single index model, then we can simply use that weighted average concept, okay, which I'm teaching you right now. So we have security LMNK, we have beta, we have random error, and then we have weights. You are required to find out what is the risk of the portfolio. If the standard deviation of the market index, so we have the risk of the market, which is nothing but 18%. Okay. Now, my dear students, we need to do the calculations of this. So see, we have security LMNK. Okay, so these are the four securities which you have it in front of you. Now, my dear students, we have here systematic risk. So systematic risk, my dear students, based on variance. So how do you calculate systematic risk? Whatever is the variance of market, we multiply that by the beta square. Okay, so simple. Because systematic risk is what? Market risk, you multiply that by beta. So because it's based on variance, we'll take the square. And as I told you, institute prefers what? Calculation of systematic and unsystematic risk based on variances. Okay. So that's why based on this will be 18 square, 1.6 square. So we'll be getting 829.44. So this is the systematic risk for security L. Unsystematic risk, they have given to you 7. But because we are taking everything into variance, so we need to square this as well. So that will give you 49. So you club it and then there is a total risk based on variance. Then you also have the weights available. So we simply have to take the weighted average. So use the same process. Use the same process for each and every security. And then we have the weights available, multiply that by the weights and take the total of this. So we'll be getting the final concept of your standard deviation of the particular portfolio, and we can take the root of it. So ultimately this will be your 25.03. Okay, so this is how we can calculate it. So simply once again I'm repeating, we'll take systematic risk, we'll take unsystematic risk, we'll be getting the total risk, and then we'll be having the weights available. So from the total risk, if I'll multiply that by the weights, and we'll be getting finally the weighted average. Okay, so this is how we'll be calculating the standard deviation of the portfolio. Take the root of it, so that will be 25.03. Okay. Now, my dear students, in your question number 52, okay, same concept is applicable. So this is also a very nice question if you want to practice, because in this question as well, we'll be having, so many things which we need to solve it here. We'll be using portfolio risk by using a modern portfolio theory as well, and also by taking into consideration your final total risk as well, okay, using your single index model. So in this particular question, what we need to do, following are the details of the portfolio consisting of 3 shares. We have share A, B and C, then we have portfolio weights, then we also have the beta, and we have expected return, and then we have the total variance. Standard deviation of the market portfolio is 10%. And the following additional data is given to you. We have covariance AB, which is 0.03. We have covariance AC. We have covariance BC. We are required to now calculate what is the portfolio beta. What is the residual variance of each of these 3 shares? What is the portfolio variance using Sharpe's index model? What is the portfolio variance on the basis of modern portfolio theory? That is Harry Markowitz. So this is something which we need to calculate it. Okay. Now, my dear students, how will you calculate your portfolio beta? So can I say that we can calculate the portfolio beta by taking what is going to be the weighted average beta. So we have securities, we have their weights, we have the betas available. So by weighted average beta, we can get the final answer, what is the beta of the portfolio. So that's not an issue. What is the residual variance? Can I say residual variance is nothing but your unsystematic risk which we are talking about. So how do we do in your residual variance? We'll be taking from your total risk, we'll be subtracting systematic risk, we'll be getting unsystematic risk. So we have the total risk, which is your total variance, 0.015, 0.025 and 0.1. So we can simply take this, and from this I can subtract my systematic risk. So what's my systematic risk? Market risk multiplied that by your beta. Okay. And we always do it on the basis of variance. So that's why beta square into variance of the market. So then we'll be getting the systematic risk, and from your total risk, if you subtract this systematic risk, what we get is this unsystematic risk. So we can then calculate the unsystematic risk, which is nothing but the residual part. Okay. And then, my dear students, we are also required to calculate your portfolio variance using Sharpe's index model. So what we'll be doing is, we have this total risk available. We can multiply this by weights, and then we'll be getting the weighted average risk. Similar to what we have done earlier in this particular question, we used the same concept. We took the total risk, we multiplied that by weights, we got the weighted average. Here also, simply, we have your uh, total risk available. Simply take your total risk, multiply that by the weights, will be getting your weighted average risk. Okay, so this is the third part of the question. And fourth part is nothing but what is going to be your Harry Markowitz. Okay, so normal model portfolio theory. So we can calculate the risk of a portfolio by taking root of weights of A square into variance of A plus weights of B square into variance of B. The same concept we are going to use it. And the covariance A, B, B, C and AC they have given to you in the question. So then we can calculate the portfolio risk, which is 0.1. So this is how we will be calculating your question number 52. Okay. Now, my dear students, we'll be doing your critical line and corner portfolio concept. Okay. So now I'll be teaching you. See, we have already done something with regards to your security market line, right? Security market line, that is nothing but the uh, graphic presentation of your CAPM model. Okay. Then similar to that, now we'll be doing, something which is called as your critical line. And basically this is nothing but your corner portfolio only. So there is, this actually critical line is applicable in every such uh, capital market lines also, and it is applicable in your also at the same time characteristic line, and then also there is something called as capital allocation line, which we will not be doing this, but it's based on the same concept where you all are aware that the relationship can be defined by taking y is equal to mx plus c. Okay, so I'll quickly revise what is this concept y is equal to mx plus c. Let's say for example, you have weights of A, B and weights of C for portfolio A, portfolio B and portfolio C. Okay. So let's say for example, you have weights of A as your, let's say, uh, 0.4. Okay. This is 0.2. Okay. So this will be 0.4, right? Now, if suppose this increases in portfolio B, if suppose this is now going to be 0.5, okay, and okay, let me take it like this: 0.3, 0.2, and let this be 0.4. So 0.3, 0.4. So this is now going to be 0.3. Okay. Then let me take this particular portfolio. Okay, listen to me very carefully. For this particular portfolio, let's say for example the weights are 0.4, and if this is 0.5, sorry, 0.3, and this is 0.3, and if suppose this is 0.5, and we need to find out the weights of these two things. Okay, So basically this concept, okay, this concept of your corner portfolio or efficient frontier or critical line. Now let me explain this to you very thoroughly. See guys, as you all are aware that while explaining least risk portfolio, I told you that we have different portfolios which are there on efficient frontier and inefficient frontier, right? And we always select the portfolios on the efficient frontier on their minimum variance set. So basically, if I have portfolio A, B, C, okay, and suppose your portfolio A has weights of A, B, and C in a particular proportion. Now you want to build portfolio B, and we also have portfolio B ka weights A, B, C, which is there on the efficient frontier. By the way, what is efficient frontier? At the same level of risk, you are generating higher returns. Okay. Now you want to make one more portfolio C, and you just know that the weights of security A is 0.5. So what should be weights of B and C? This is something which we need to find out. But we want to keep all these portfolios on the efficient frontier. So how should we determine the weights of security B and security C in your portfolio C in such a way that it be the efficient frontier? So for this particular case, we need to take the help of the relationship between A and B and develop an equation which helps us to identify what should be your weights for security B and security C in the third portfolio. Okay, so this is something which you are going to learn in the concept. So basically, if you just check here, I've just created one random example. Okay, can you see that portfolio A, B, and C, we have weights of A, which is 0.3, this is 0.4, this is 0.3. Portfolio B, there are three securities where it is 0.4, 0.3, and 0.3. Okay. And then, my dear students, we have portfolio C in which weights of A is 0.5. So we need what should be weights of B and weights of C. So I can do this if I create the relationship, of weights of A and weights of B in these two portfolios. Then I can use this equation to also determine what should be weights of B here, because all the portfolios are there on the efficient frontier. Okay. So in this particular case, okay, how can we do it? See, uh, we have weights of A as 0.3, we have weights of B which is 0.4. Okay. So what is Y is equal to mx plus C? Your Y is, let's say, weights of B which is 0.4. Okay. So let this be 0.4 is equal to m into what is x? Your x is 0.3. It is 0.3 plus, let this be C. Okay. Similarly, this y is 0.3. So let this be 0.3 is equal to m into what is this x? This x is 0.4. Okay, 0.4 plus C. So can I say that if I solve this simultaneously, okay, equation 1 and equation 2, what will I get is 0.1 is equal to this will be minus 0.1 m. So your m is going to be minus 1, which I substitute in equation 1. So this will now be 0.4 is equal to minus 1 into 0.3 plus C. So this will now become 0.4 is equal to minus 0.3 plus C. So your C will now become 0.7. So that is why you will now get y is equal to mx plus C, where y is we have to find out your m has come as minus 1x plus C is 0.7. So this is one equation which we have developed. What is the outcome of this particular equation? It will help us to find out what is going to be your weights of y when x is this much, or what should be your weights of x when y is this much. Okay. So basically, your m is called as slope of line and C is called as your intercept. Okay. And both of them are always going to be constant. Okay. On this entire efficient frontier, this equation is now constant. Now, my dear students, if my x is 0.5 and if I want to know what's my y, So can I substitute this? Yes, y is equal to minus 1 into 0.5 plus 0.7. So the moment you do this, this will be minus 0.5 plus 0.7. So your y is coming as 0.2. So this should be coming as 0.2. So now if this is 0.2, if this is 0.5, so this has to be 0.3. So this is, my dear students, how we establish the relationship. And then we have to determine what should be the weights of the other security. Then based on this relationship, we can do it. See, you all are very intelligent. You all can just analyze the data by seeing, and you all can come to know what should be the weights of B and C. So usually my students do this. They tell me, sir, this is 0.3, this is 0.3. So this also has to be constant 0.3. And if this is 0.5, so this has to be your 0.2. Okay. Also at the same time, if this is increasing by 0.1, this is decreasing by 0.1. If this is also increasing, then this will also be decreasing by 0.1. So it's very evident. But in exam, you cannot present it like this, right? You won't get marks. So for that, we have to determine critical line and develop this relationship. And based on this, then we have to calculate what should be the weights. Okay. So now I'll just make you understand this particular question. Okay. Only one question of its part of the same thing. Okay. So let us now come to your question number 53. See, what is there in question number 53? An investor has two portfolios, which is known to be on the minimum variance set for a population of three securities A, B, and C having below mentioned weights. So we are having portfolio X, Y, we have weights of A, B, and C. It is supposed that there are no restriction on short sales. So short sales, it's permissible. What would be the weight of each for the portfolio constituted by investing 5,000 in X and 3,000 in Y? And suppose that the investor invests 4,000 out of 8,000 in A, how he will allocate the balance between security B and C to ensure that his portfolio is on the minimum variance set. Okay. So my dear students, we are actually required to calculate. First part is what is the weight of each stock. Okay. By investing in portfolio X and portfolio Y. So if we invest 5,000 in X and 5,000, 3,000 in Y. So how do we approach this? So see, we are investing in X 5,000 rupees. We are investing in Y 3,000 rupees. Okay. And the weights available is, as you all can see, 0.3, 0.4 and 0.3. So this will be 1,500, 2,000 and 1,500. Similarly, we have weights for A, B and C in portfolio Y as well. And simply, my dear students, by taking the total of this, we'll be getting 2,100, 3,500 and 2,400. Now, my dear students, I can very well calculate the weights. So 2,100, if I divide that by 8,000, I'll be getting 0.265. Similarly, here this will be 0.4375 and this will be 0.3. So these are the total weights. Okay, so what is the total weights? Suppose you have created two portfolios, and in one portfolio you have invested in A 1,500, in another portfolio you have invested in A 600. So together you have invested 2,100 out of 8,000. So that is why your weights will now become 0.265. Okay, so that's your weights of A. Okay. Now, in the second part, we are required to find out what should be your weight C. As you can see, suppose the investor invests 4,000 out of 8,000 in security A. So now he's investing, he's creating one more portfolio. So as you all can see, in this one more portfolio, we are investing 0.5 in your X, in your weights of A. We don't know weights of B, we don't know weights of C. Okay, which I told you very easily you can do it. Okay, but we have to do this by a particular method. Okay, which you'll also see this in the study module. So y is equal to mx plus c. We can do this accordingly. And based on this, once we got the equation, now we can substitute the values and then we can get the weights. Okay, so that is 4,000, 1,600 and 2,400. So that's how the calculation can be done. Perfect. So I hope, my dear students, you all have understood this, your question number 53. Now, my dear students, I'll be revising what is this capital market line. Okay. Now, what is this capital market line? Okay, capital market line, my dear students, it's nothing but the relationship of the risk of a portfolio with the expected return on the portfolio. So this is how we will be calculating what is going to be your capital market line. So what's your capital market line? Your capital market line is nothing but the relationship of your risk of a portfolio with the return of the portfolio. Okay, risk and return of the portfolio. Now, my dear students, how are we going to understand this? See, first of all, as you all are aware about how do you calculate the expected return on a portfolio? That's nothing but your risk-free rate plus RM minus RF into beta of the portfolio. Now, we assume in capital market line that whatever is your uh, portfolio, it has the correlation coefficient with the market as +1. Okay, so there is going to be perfect positive correlation with the market. So a portfolio is going to move exactly in the same direction with what the market is going to move. Okay, so in this particular case, what is going to be your expected return on a portfolio? So that is RF plus RM minus RF. And what is beta of the portfolio? Can I say beta of the portfolio is nothing but correlation coefficient of portfolio with the market into standard deviation of the portfolio upon standard deviation of the market, right? So that is why if I say that the correlation coefficient of the portfolio with the market is +1, okay, if this is +1, then RF plus RM minus RF, you will be left with the standard deviation of the portfolio upon standard deviation of the market, right? So this can be rearranged and written like this: RM minus RF upon standard deviation of the market into standard deviation of the portfolio. Now, very soon you will realize that this is nothing but return on market minus risk-free rate upon risk of the market. And this itself, we call it as your Sharpe's index, isn't it? Can we call this as your Sharpe's index? Come on, yes or no? Yes, sir. Because what is your Sharpe's index? Your Sharpe's index is nothing but whatever is the premium over the risk-free rate, and we divide that with standard deviation. So this is your Sharpe's index. So whatever is your Sharpe's index of Nifty, of market, that will be taken into consideration while determining the expected return on the portfolio. So expected return on the portfolio, can we write down this as RF plus Sharpe's index into whatever is the standard deviation of the portfolio. Okay. Now, my dear students, this itself can be presented in that equation of y is equal to mx plus c. So your expected return, we can say this is your y. Your risk-free rate, it's a constant c-intercept from where the line starts, from where the slope starts. So that is going to be your c. Your Sharpe's index can be written as m, which is the slope, and your standard deviation of the portfolio can be written as x. Because as I told you that we are creating a graph in which the standard deviation of the portfolio comes on the x-axis and the return comes on the y-axis. So we can present it like this: y is equal to c plus mx. So now we have got the same equation: y is equal to mx plus c. Y is equal to what? Mx plus c, my dear students. So basically here, what is the slope of the line? The slope of the line is the Sharpe's index of the market. C is nothing but the risk-free rate, and Y is your expected return. So what is the application of capital market line? That if you want to find out what should be the expected return of the portfolios at different levels of risk, we can do that. If I know the Sharpe index of the market and if I know what's the risk-free rate. So are you understanding this? When this concept will be used, my dear students, this concept will be actually used when you really want to know, that what is going to be the expected return of the portfolio at different levels of risk of the portfolio. And what do you have it with you? You have Sharpe's index of Nifty available and you have the risk-free rate available. Okay. So sometimes if institute will ask you that, please calculate the expected return on the portfolio. Okay. If they ask you calculate the expected return on the portfolio, and then they give you that this is going to be your, Sharpe's index and you have to do this accordingly, then, this is the entire concept which we'll be using and we can do this accordingly. Okay. Now, my dear students, based on this, we can calculate your different types of your returns. So let us do this particular question on capital market line. This is also not there in the study module. It's there in the practice manual, and I've taken that also into consideration because you never know that if institute can ask you a question on capital market line out of nowhere as well. Okay. So expected return from the market is 20%, standard deviation is 25. Can you see Nifty return is given, Nifty risk is given, risk-free rate is given. Find the market risk return trade-off slope. So we are required to calculate Sharpe's index. So we can calculate Sharpe index by taking whatever is the premium of the market return, which we divide that by the risk. So that's how we'll be getting the Sharpe's index. So you can see that the Sharpe's index is coming as 0.48, which is also called as the slope. And then find out the expected return of the efficient portfolios. Efficient portfolios are those in which the correlation coefficient with the market is +1, whose standard deviations are 15, 25, 30, and 40. So at different levels of standard deviation, what is going to be the expected return? That is something which we need to calculate. So y is equal to mx plus c, and based on this, you can just simply take the different levels of risk. So as I've defined, what is y, expected return? What is risk-free rate? That is your c. Okay, Sharpe's index is your m, and then we have the risk available. We just have to substitute the values and get these answers. So if you have not done this earlier, please make a note of this. You can just pause the video here and copy this down. Also, at the same time, the application of the capital market line can be done something like this as well. When the actual returns of the portfolio are above the CML, then we invest it. Very similar to the security market line, because these are underpriced instruments. And if suppose your actual returns are lower than the CML, then we don't invest because these are overpriced. Okay, so that is also where the application can be done. Now, my dear students, we will be doing the last thing, which is your characteristic line. Okay, and your characteristic line, my dear students, this takes into consideration on your y-axis and your x-axis. What does it take into consideration on your y-axis? As you all can see, it is the excess return over the risk-free rate, and on the x-axis, it takes into consideration your excess return over the risk-free rate. Okay, so basically, RA minus RF. Suppose the return which is provided by a portfolio or a security is 15% and your RF is 7%. So 8%. What is the excess return? We plot that on the y-axis, and whatever is the excess return of the market over the risk-free rate. Suppose market has provided a return of 10%, and if your RF is 7%, so 3% is the excess return which will come on the x-axis. So basically, we plot this in a graph and we derive characteristic line. So in this also I've derived, okay, I actually don't have much time for to explain this in detail, so just revising it. As you know, because this characteristic line comes from your Jensen's alpha. So alpha is what? Returns minus CAPM return. Okay. So if you know this, then if I just simplify this further, then RA minus RF, this comes on your y-axis, and RM minus RF into beta, this comes on the x-axis. So this is nothing but alpha is equal to y minus x into beta. So again, rearranging this, you will be getting y is equal to mx plus c, where y is nothing but the excess return of the security over the risk-free rate. X is the excess return of market over the risk-free rate. M is the slope of line, which we term it as beta, and C is your Jensen's alpha. So based on this, we calculate it. So that's how we'll be getting your characteristic line. Okay. So in this particular question, what is required? We are required to calculate what is the characteristic line for stock A, the systematic and unsystematic risk. Okay. So how do you calculate your systematic risk? As you all can see, your systematic risk is nothing but whatever is your standard deviation of the market into beta. Okay. And unsystematic risk is from the total risk, will be subtracting systematic risk. So which all things which will be required here? So beta, we will require it with the help of the joint deviation, and we also need the risk of the security. So this is the entire table which we need to prepare. I've just given you the values here. You can calculate this on your own, and then eventually we'll be getting systematic risk and unsystematic risk, okay, based on your standard deviation, which is coming as 7.6, and your unsystematic risk is coming as 1.5, okay, and your beta is 1.2. So the first three parts we can calculate it accordingly simply by using the formula and the characteristic line. So as I told you, the characteristic line is y is equal to mx plus c, where y is your expected return over the risk-free rate. Then what's your x, expected return of market over the risk-free rate. M, which is the slope of the line, that is beta, and C, intercept, that's your Jensen's alpha. So based on this, my dear students, you can calculate it, and we can eventually get y is equal to mx plus c, and this is how the equation will be derived. So that's the final part of the answer. So my dear students, we have revised 55 questions of your portfolio management in this very little time which I've got. Try to cover each and every concept, and wherever the questions were required your attention, I've done this all. Wherever there's a tricky part, we have done it. And I hope you'll have understood all these 55 questions very thoroughly. Your task is to just solve this very thoroughly and very properly. Now for Sharp's optimal portfolio, I don't want to just revise this in haste, so I'll giving you a complete video on that. You can just check the playlist for Sharp's optimal portfolio. And then also for Project Beta, there will be a separate video, so you can just have a look towards that as well. Okay. So with this, now I can say that your portfolio management is completed. So only thing which is left is Sharp's optimal portfolio, which I told you. You can just check the separate video for the same. You can, check for the updates. You'll be getting this here, where I'll be explaining that in little bit detail. Okay. And then also, because that is something, if I revise it, you'll not understand it. Just by doing this, you'll not be understand. So I'll just solve it once. And for some questions on Project Beta also, I'll be doing it. So you can just check Project Beta thumbnail for a particular video. You can do that accordingly. So with this, your portfolio management chapter is now over. I hope you have enjoyed, you have understood. That's it from my end. Bye. Take care. See you.